Hello traders, Gary Wagner here, just about 10:20 in Honolulu, 4:20 in New York. It is Wednesday, April the 12th, 2017, and this is the Daily Report for Gold and Silver. We see gold surging once again, currently trading up about $12 on the day. Interesting turn of events because for the majority of the trading session, gold was trading higher, but nominally higher, up about $2 to $4 higher, till statements made by Donald Trump in an interview to Wall Street Journal in which he suggested that the U.S. dollar was too strong. As the dollar came down, of course, that bid up gold. As we look at futures right now, and we're looking at most active June futures, they are trading at $12.8590. Putting it up about $11.82, a net rise of almost a full percent. The high on the day has been $87.40 with a low of $73.80. Of course, we went long this market yesterday, and we will talk about our current trade as well as exit strategies and upside targets in detail as we pull up our first technical studies. When we look at spot or cash gold is at $12.84, putting it up approximately $10 on the day, the low 72 and change, and the high 85 and change, net change about 0.8%. Over to silver trading up over a full percent, 1.1%, trading 20 cents higher at 18.45, and that of course is most active futures contract. When we go over to spot silver, that is trading currently at 18.44. Something that we absolutely need to look at on today's show is the dollar index, which has been falling out of bed. It was trading lower this morning, but once that interview came out in the Wall Street Journal, of course, it was picked up by all of the news sources, and we saw a dynamic change in the dollar index, which is currently trading off approximately 0.5% on the day at 100.13. Traders, as I said, we currently have gold trading off roughly $13 right now at $12.87. And yesterday's breakout and break above the 200-day moving average was absolutely significant. First of all, you know that was really our trigger to re-enter the market, as we had seen this market tackle with these recent highs and not have the ability to break above it. In fact, when we look at the action last week, we had this tremendous spike above that particular price point, taking gold prices roughly to $12.80, only to close well below that in the $12.60 area by the time the market closed and settled. However, that all changed yesterday. This upside spike not only took the market well above that, but as we talked about in many of our former shows, it was the fact that it closed above this particular price point that I believe is extremely significant. Of course, we entered long positions at $12.73, and as I said, the market is currently trading now. It is a moving target. It's trading almost $14 higher at $12.8790. If you recall from yesterday's show, we talked about different price points that we would look at as our exit strategy, where we felt we might find some sort of resistance, and other points where I felt we should be able to tackle them pretty easily. The first point that I said we should have no trouble getting through was this 61% retracement that comes in roughly at $12.79, and that is this particular line here. It is also a Fibonacci harmonics in that I've got a long-term fib retracement along with a short-term, both accounting for this being at the same particular price point. The things that we want to look at in terms of potential tops and areas, as I said, my upside target in a best-case scenario is roughly above 1225 to 1233, and that is based on this Fibonacci extension, which is a one-to-one relationship between the rally which began at the beginning of last year, took us right up to the 200-day moving average, and then as it came down and settled at roughly 1190 right here, the extension starts from this point, or the beginning of the second leg of this rally this year. My sense is that we will easily see this market at least go to a one-to-one relationship. In other words, all I'm saying is that the subsequent rally and the current rally should be at least the same size. That's based on Elliott Wave strategy as well as trend following and looking at recent rallies in gold and looking at their basic length or how far gold prices will ascend during those particular points in time. Now, where do I think we can find some potential resistance? 1300, as I said yesterday, would be my first area that I would look at. And we do have a 78% retracement at 1302. But I am looking for the potential for an upside target at 1233. But I draw your attention to this dashed line right in here that comes in at about 1319, and what you'll see is it lines up with a couple of different spots. This particular one and then another one at 1310. 1310, you'll see, was the actual top that the market traded to back in November of last year. And when we look at how the market traded prior to that, and I'm talking about July, August, September, and October, we can see that on 4 separate occasions, we had the price come down to this area of 1310, and it provided, on a technical basis, a clear level of technical support. We also get confirmation that this particular price point is extremely strong because when it broke through that, look at the size of this one-day move, this candle move that came in here. And that really, to me, is significant because it says that once it broke through this price point, we now had a level of resistance. The market went down to what, about 1260, and as it moved up, we then see this price point becoming a top. So traders, assuming that the market continues to rise, of course, and assuming that it breaks above 1300, my sense is that we want to look very carefully at the area of around 1310, and based upon past ways that gold has acted at this price point, this is a true level we could experience some resistance. But traders, if in fact we do, that means that gold will track and trade at least another $20 higher from this point. In other markets that we follow, U.S. equities continue to trade under pressure. They continue to trade in a narrowly defined range, and they continue to trade lower. Dow Jones Industrial Average down about 60 points at 20,591. Standard & Poor's 2344, putting it down about 9 points on the day. We're looking at nominal changes about 0.4%. And then over to NASDAQ, off about 0.5% on the day, lower by about 29 points at 5837. And lastly, did want to take a look at crude. As we talked about, crude hit those highs at around 54, but over the last couple of trading days, we have seen the market come lower. Yesterday, although it was up, came off of the highs that it was trading at. Today, we are trading off by 51 cents per barrel at 52.89. So traders, if you recall from yesterday's show, we talked about the fact that we have seen the U.S. dollar come under some weakness over the last couple of trading days. Of course, today being Wednesday, this is Monday here, this is Tuesday's trade, and we noted the fact that the market traded and closed just below the 50-day moving average. We then looked at some key areas in which we felt the market could continue to trade lower too, one of them being just above 99, and we'll have to put up another chart, but that's based upon a Fibonacci retracement point. And then the second target that we had, if you recall, was 99, and that's based upon extending this 200-day moving average. But there's no doubt when we look at the kind of market moves we've seen, we're trading off about 0.55% over a 0.5% drop in the value of the dollar. That is largely responsible to the surge, the late surge that we saw, of course, in gold pricing. Of course, this coming on the heels of a statement made by President Trump in an interview to the Wall Street Journal in which he stated he believed that the dollar should be weaker. It looks like he is certainly getting his wish. Traders, I believe that this market could continue to trade softer, and I don't believe we'll find any technical level of support till about 99.27. That is the first area we want to look at. We are looking at another dollar chart. This is still a daily chart, but in Japanese average format. However, we have added a Fibonacci retracement. This retracement begins in the activity that happened in May of 2016. The market was trading roughly at 92 and takes it up to the most recent highs that occurred at the end of last year when the dollar index traded as high as just shy of 104, 103 and change. So there's our ending point and our starting point. Of particular interest to us is the 38% retracement level. And as I said, that comes in just above 99. On this chart, it's coming in at about 99.18. The reason for the differential is prices are different when we look at a Japanese average chart as compared to a candlestick chart because of the way that those come in. When we do that, we also see these series of lows that come in roughly in that area to just below 99. We know that that is significant. We can see at least a couple of occasions this year that the market traded down to this price point and then found support, and from there used that price point as a springboard to move to higher ground. Now, what we have seen is when we look at the big picture, meaning as the dollar was rising, we had a series of higher highs, we had a series of higher lows come into the market, and that was up until we hit these tops just below 104. Now we can say with some degree of certainty, because time has passed and data has actually allowed us to make this observation, and that is now we're getting a series of lower highs and lower lows. Traders, based upon our recent studies, based upon our technical indicators, my recommendation is to maintain your current long position and to maintain your current stop. This has been Gary Wagner wishing you, as always, good trading. We'll talk to you tomorrow for another daily update and review. Bye-bye.